Okay, good morning, guys. Final day of the week. Let's get cracking here. We've got definite some dollar strength just in the mix here. We've got euro dollar down through the key price point from yesterday afternoon. So tracking back lower, having had a positive morning yesterday. Quite choppy through the afternoon, but ultimately now we're kind of heading back towards yesterday's lows. You've got cable also under pressure. If I just bring the cable chart in, I mean cable more so than euro dollar on the downside, breaking. This is new lows for the week, of course, for sterling versus the dollar, but this has been a slightly different story. We'll talk about this in due course, but let's just review yesterday. So really, another negative session for equities. If you look at my S&P chart, top left here, then another phase to the downside, particularly, drifting lower, really right from the European Open, drifting lower and then picking up momentum as we hit the European close. And being balanced, we're back flat overnight. So it's been another kind of US earnings story. And let me just show you on the daily chart first before we get into the meat of it. So, we've come off, this is 3 days in a row now, and, as it stands on the candle, you can see for today, very early days, obviously, in today's session, but currently it's red. But, this is a decent pull-off away from the top of this range we've been talking about, the sort of 4 or 5 month range that we've been in, pulling back into the middle part of this range as earnings have disappointed. Apple and Microsoft did the damage earlier on in the week, and it's the likes of Caterpillar and Dow Chemical and McDonald's, these big hitters delivering either weak numbers or weak forecasts, depending on which company you're talking about. I mean, if we looked at Caterpillar, for example, then quite remarkably, Bill was telling me a stat earlier on, they've had 32 months worth of consecutive decline in sales, which is just extraordinary. 32 months straight of declining sales for Caterpillar as they continue to they continue to suffer, not from the US. I mean, in their sort of conference call after the earnings numbers were announced yesterday, they spoke about economic conditions in the US being reasonably positive. It's not the US, it's the rest of the world, and Caterpillar's a great stock to track to get a handle on global growth. And 32 months of declining sales tells the whole story, and that is that the global economy is weak, and continues to be so. Caterpillar very exposed to territories like China, for example, and they're very exposed to commodity prices, which of course have been declining and declining. I mean, it's been the big story of the week, really, and the big story of the year. But certainly this week, the commodity space declines really taken over as that kind of headline risk. The China risk with the equity market collapsing, the Greek default risk, these were headline risks. They've kind of gone away a little bit. And what's replaced them is the US earnings season and just this week, the turn for the worse, okay? And also then the commodity space. So Caterpillar's exposed to this. A lot of their products that they sell are used for commodity mining, for example, and so copper and coal and iron ore, these prices collapsing. This has squeezed demand for Caterpillar's engine sales and equipment used in energy construction sites. Okay, so their guidance for the rest of the year was terrible. The actual earnings numbers themselves were fine. They just about met expectations, but it was the forward guidance that was the key thing about the Caterpillar report, and that's why their share price dumped about 5% yesterday. Dow Chemical suffering for similar reasons. McDonald's delivering sales that were weak. So overall, earnings yesterday again contribute to the downside. We had data as well, like jobless claims came in at 255,000, which is remarkably low. In fact, I think I read a stat in the FT this morning. I think I'm right in saying it was the lowest jobless claims number since the 1970s. But they believe a lot of this is really just a hangover from, well, not a hangover, but it's as a result of automotive industry retooling shut down a couple of weeks ago that led to a push higher in jobless claims, and this has come back out of the equation, so maybe there's some seasonal effects in that number, but 255 is just extraordinary. The 4-week average for jobless claims is now 279. This is definitely pre-crisis, back to pre-crisis lows, if not better than pre-crisis lows. So, but that wasn't enough. It was the earnings that did the damage, and this is what led to the decline in the equity space. We have on the earnings front had a slightly turn for the positive though overnight, because Amazon delivered their numbers and they absolutely smashed it. Their share price was up 19% in aftermarket trade. Let me bring up a little bit of a chart here of the Amazon share price and comparing it to, this isn't share price, this is valuation, because what happened yesterday off this massive spike, 19% higher, it basically has taken Amazon up and above Walmart for the first time in history. Amazon has now a higher market capitalization than Walmart, which is pretty extraordinary. I was looking into this, just comparing the two firms. Obviously, they're in the same space on the one hand, in that they're giant retailers, but then they're very polar opposites on the other hand. Walmart, physical in-store sales. Amazon, of course, that kind of beacon for the switch into online retail. Amazon, I thought they were an older company. I was looking into this. I thought Amazon were a lot older, but actually they were founded in 1962. I was trying to find a stat. I was expecting them to be like more than 100 years old, but they're not. They're only 53 years old, Walmart. But check this out. They've got 11,495 stores, which is just mind-blowing. Their revenue, full year 2015, expected revenue for Walmart, 485 billion. Okay? Full year 2015 expected revenue 485 billion. Amazon, well, I haven't got a full year 2015 expectation, but the 2014 revenue was 89 billion. So from a revenue perspective, Amazon's revenue is 5 times less than Walmart's, and yet they've got a higher market valuation despite their revenue being 20%, only 20% of Walmart's revenue, yet they're worth more. And this is the multiple on Amazon is just extraordinary, into triple digits. But this is, Amazon's a phenomenal story, make no mistake. Amazon only got going in 1994. Jeff Bezos decided to flog books online out of his garage in Seattle, and then over the years, it's grown into this absolute monster. But their Prime services has been rocketing. They don't just sell books, obviously, these days. There's video streaming, there's the Kindle, there's pretty much anything you can possibly imagine. But Amazon's never quite been the kind of Wall Street darling it might have been. And that's because of Jeff Bezos is quite, not unique, but unusual style of doing business, and that involves basically ploughing all profit pretty much back into investing in the company. The Amazon, if I scroll down, let me just show you their, let me just make this a bit bigger. Let me just show you this chart, which is looking at revenue and profit. I'm going to just try and make this a bit bigger so you can perhaps see it better. Give me a second. So this is looking at their revenue and their profit out over the last sort of 15 years or so. And so the profit is the blue bars, and you can see there's some notable big losses in here. Revenue's been consistently increasing. If you can see the revenue bars in amongst these volatile blue profit bars, the revenue's consistently climbing. Notable periods of big losses, and this is not because they're underperforming. This is because they've invested huge amounts in strategically placed warehousing facilities to ever reduce the amount of time it takes to deliver products that people order online. And now we have same-day delivery, and properly Amazon have arrived as a absolute direct, proper competitor to physical stores, because the one thing physical stores have always had, the one advantage is consumers can buy it and take it home straight away. Well, now you can buy it online and have it at home straight away as well in the same day. The only advantage the in-store sales retailers have, of course, is you can actually go and pick up the physical product and test it out and have a feel for it before buying it. And as of yet, Bezos hasn't quite managed a virtual reality facility to allow you to do that online. Who knows, maybe in the future. But for now, the amount of money they've invested in warehousing very close to major sort of metropolitan hubs has enabled Amazon, and through their Prime service, to deliver same day. And this is now bearing fruit, and their online cloud service has seen huge growth, 81% growth on online cloud services. So these are the areas of the business that have turned a profit. And so we weren't expecting a profit, but we got one, 930 million profit for the quarter. Analysts were expecting a loss. So Amazon delivered huge numbers overnight, 19% higher. They're now bigger than Walmart. However, this has not sent the S&P back higher. I mean, it's stabilized the ship, but we're still flat, well, just marginally higher on the day. So the good news from Amazon has perhaps offset a little bit of the bad news we've had from Apple and from Microsoft and from Caterpillar and from Dow Chemical and from McDonald's, okay? But as it stands, we're still obviously well down on the week. So that's the earnings update. Mixed news, but ultimately stocks pushed lower yesterday and kind of hanging on to some of those losses. Now, let's talk about commodities, because I mentioned them there when referring to Caterpillar. So another big down day for crude oil yesterday. So a couple of big steps lower. Eventually it was such a mess on Wednesday after the inventory data, but by the end of the session, the oil properly broke lower and tested $49. I mean, I don't know. I said on Wednesday, if we get bearish data on inventories, we're going to break 50 and test $49. And that's exactly what happened, except trying to trade that was a nightmare because of the noise that was created off the inventory data and the inability initially for oil to sell off. Anyway, eventually it happened. We hit 49, consolidated overnight. That's over Wednesday night into Thursday morning. Break lower yesterday afternoon, breaking $49, down to $48.21, stabilizing. This is a classic trend. Look at the daily chart, though. This is definitely what we expected, just not straightforward to trade. But the thing about this is, oil's now in a bear market. Technically, if a market drops 20% off its recent high, it's a bear market. If you calculate this percentage move, the high point that we had on the 6th of May down to the low point from yesterday, that's 23%. Now, what's notable about this is the second bear market of 2015. We had a bear market at the start of the year. We've got another one now. Also, commodities generally across the spectrum are weak. We talked about gold down to whatever it is, a 5-6 year low for gold. Other precious metals suffering as well. And then just the industrial metals suffering, copper repeating its kind of cycle lows, iron ore very weak. So the commodity spectrum continuing to come under a lot of pressure. This is mainly due to a weak China. It's mainly due to a strong dollar. What's interesting about this is have a think about how this has or might have an effect on the Fed. Because inflation is, of course, the key kind of measure that the Fed and the Bank of England are monitoring when it comes to thinking about the timing of interest rate hikes. Now we've got a second kind of phase of weakness in the commodity space. We had the first phase end of last year, start of this year. Now we've got a second phase. Now, is this going to see headline CPI numbers remain lower for longer? If so, this may well see interest rate hike expectations get pushed out again. So this is something to think about. I mean, we'll see and track this, but let's say oil does return back down to $42, which on the continuation chart is the low of the year. I mean, we've got a pretty pronounced trend on the go here, and there's no reason it's going to stop here around about $49. So if we do see a continuation of the weakness in the commodity space and it lasts into August, let's say, well, it's probably going to have a notable negative effect on the inflation outlook again, which can disrupt interest rate expectations. So that's something to think about. Now, having mentioned the Fed, Deutsche have come up with a very interesting analysis, and they're saying that, look, everyone's talking and worrying about when are the Fed going to hike rates, but Deutsche have come in with an interesting different angle on this, and they say, actually, forget about when the Fed are going to hike. What's more important is what they're going to do with their reinvestment of their assets. So what that means is the 3 rounds of quantitative easing that the Fed have gone through since 2008 meant they buy assets, right? And their balance sheet is upwards of $4 trillion now. Now, the strategy so far, they've stopped printing money. They're not buying any more assets, or they're not buying any new assets. But at the same time, you've got to understand that some of these assets they hold are maturing because they're bonds. So some of these bonds are hitting maturity. So what are they doing in that scenario? And at the moment, they're reinvesting, because what they want to do is keep the money supply unchanged, right? They're not expanding the money supply anymore, but they don't want the money supply to contract. So they're keeping it unchanged, which means when these assets they hold mature, they receive the money back, the redemption payment comes back from the government, but then they use that money to purchase other assets to keep the money supply flat. Now, what Deutsche Bank have done is an analysis on 2016. I've got a couple of charts here for you. Don't ignore the left one for a minute. We'll talk about that in a sec when I talk about the euro-dollar outlook for the rest of the year. I want you to focus on the right-hand chart here. And this is looking at monthly balance sheet reinvestment. Okay, now what the Fed have said previously in terms of how they're going to handle their exit strategy is first they're going to hike rates, then they might start or might stop reinvesting redemptions. And this would, of course, mean that money supply drops. So the question that Deutsche Bank are raising is the bigger deal for markets is actually when the Fed announce they're going to stop reinvesting. Okay, this is a second part of their exit strategy, not just raising interest rates back to normal, but also returning the money supply back to normal. Now, the thing about this is, in 2016, they got a huge amount of bond redemptions. It's actually about $500 billion. So in 2016, the Fed have got $500 billion of their assets maturing. Now, what Deutsche is saying, if the Fed decide to hike rates at the end of this year and then stop reinvesting next year, that would see the money supply drop by $500 billion. That's like a whole quantitative easing package, pretty much. And so the Deutsche is saying this is a bigger risk, and we need to be monitoring when the Fed stop reinvesting, and if it's in 2016, this could have a very dramatic effect on the money supply and could see monetary conditions tighten way more than would happen if they just hike rates at a slow pace. So I think this is a very interesting new angle, and this, I think, will become a much bigger story as the months go on. And if we ever do get the Fed hiking rates, although I've just said it might now take longer, given that inflation might stay lower for longer because of the commodity price squeeze, I think this will become a really hot topic as we go into the end of the year. So I think this is a great shout from Deutsche Bank. Very good analysis and something we need to start thinking about. Now, the other chart on the left is something entirely different. This is looking at European purchases of foreign bonds and equities. What are European investors doing with their money? And what they're doing is taking it out of the country. So we've got a record post-crisis outflow of funds in the month of May. Okay, not since 2007 has this amount of money flowed out of Europe from an investor's point of view. So this is European investors buying international assets. Now, this, along with what I've just discussed, i.e. the Fed hiking, but also the potential hawkishness that is the halting of bond redemption repurchases, these two factors should lead to the euro-dollar tracking lower for the second half of this year. So this is our central view. Here's the daily chart on euro-dollar. What we expect is this market to track back to the low of the year. So this is down around the 105 handle, and maybe even lower. Deutsche Bank are going even further. If I go to a weekly chart, Deutsche Bank is saying parity by year end. Okay, so this is a pretty big call. Parity by year end would mean a move down to 1. Okay, that means €1 buys you $1. The last time we were at parity was, well, over 10 years ago. So this is their central base case scenario. Euro-dollar to parity by year end could definitely happen. I don't see any reason why not. I'd probably share this view if we get the rate hike, and if there's any mutterings they're thinking about halting their reinvestment program, then for sure we can get down there. So, quite an interesting call. I'll send this Deutsche Bank report, but just for today, this is all medium to long-term stuff, of course, but for today we've had weakness. If I go to the 1 hour chart here on the euro-dollar, along with cable sliding down through yesterday afternoon's low, where we're just finding a bit of resistance now. We've got the morning's high to contend with. I'm just going to add another line there. We've got a morning's high, so there's resistance really between 109.59 and 109.63. Okay, so a couple of resistance barriers as this market bounces after this sell-off. But just thinking about cable, I'm going to bring cable in here. Sterling versus the dollar, so this broke lower as well. We've had plenty of hawkishness from the Bank of England earlier in the week, and indeed last week, which has kept sterling higher. But bad retail sales results yesterday helped the reversal of this. That was the big move off the highs yesterday morning. Retail sales coming in negative. And this decline has just continued as we've gone through this morning so far. We've got a big level at around about 154.50. What's interesting for cable, though, look at the 4 hour chart. I've got a great pennant here on the medium term. If you look out over the last 2 months, a great pennant formation. We pretty much, false breakout yesterday morning, and then the bad news on retail sales capped the upside. But what happened yesterday was that we hit this key resistance from the 15th of July and the 17th of July highs, and that was enough to contain this break of the pennant, and we're back into it. Okay, and looking on the daily chart, you can see the kind of pennant here as we consolidate after the ultimately the large bounce off the April lows as the dollar weakened again after a very bullish move for the dollar into in quarter one. So pretty interesting on the currency space. Lots to think about. Now, if we think and switch our attention to the bond markets, so the Bund continues to track higher. It's been a very nice upward trend this week, and not just this week. Over the last, if you go back to the 13th of July low, this has been a huge move and a very consistent one. Rarely have we had any downside. Obviously, the notable one here was on the 16th of July, but aside from that, it's been a pretty steady march higher. Now, this morning, we've broken up above the key resistance point throughout yesterday's session, around 153.45, 46, repeatedly resistance. Well, that's been taken out this morning first thing. We're now pulling back and finding support at that price point. Okay, so technically important around about this area. So this is the safe haven debt market for Europe, and as stocks have drifted off their highs, it's been a negative week for equities, and this has helped continue the march higher for the bond space. Right, let's have a look at the calendar for today. Let me just bring this into shot. Now, we've been getting services PMIs and manufacturing PMIs. So it's the day for preliminary July manufacturing and services numbers. Now, China delivered news last night, worse than expected. actually a 15-month low on the Chinese HSBC manufacturing PMI, 5 months straight below 50. Remember, for these PMI numbers, any reading below 50 indicates that the manufacturing conditions are contracting. This is bad news. However, I mean, the Chinese stock market's done 7 days straight on the upside, despite this data, still managing to hang on to some small gains, and so more evidence really that the Chinese stock market is perhaps the worst barometer for the Chinese economy there possibly is. But bad news from China overnight on manufacturing. The Japanese numbers were better than expected, though, that offset that. So mixed news out of Asia. But as we went through this morning, let me just pull this lower and refresh the screen. Hang on. So we've had French numbers and German numbers, which were mixed. German manufacturing was lower than expected. German services were actually also lower than expected, and the French figures disappointed as well. So not particularly good. But when you look at German manufacturing over the last 12 months, you know, where we are here, yeah, it's worse than expected, but it's pretty much same kind of numbers we've been seeing for the last few months. There's nothing to get too concerned about here, but the data was worse than expected. What have we got left on the slate for the day? 10 o'clock, or sorry, actually 11 o'clock, we got a T-bill auction out of the UK. This is not going to be a factor. That'll be no problem. So really, from here onwards, we're looking at the manufacturing data and the housing data out of the US this afternoon. We've had some phenomenal housing numbers out of the US over the last week. Housing starts, building permits, 8-year highs. Existing home sales, 8-year highs. So we got new home sales today at 3 o'clock. Expect the same kind of stuff. Very strong housing numbers. We also get the manufacturing PMI number preliminary for July at 245. And that's it. On the earnings front, you know, it's a quieter day today. I mean, we've had the big guns report this week already, and as we've discussed, in the main, Amazon aside, it's been a pretty disappointing week on the earnings side. But some big hitters in the UK, like Vodafone, you know, the biggest of all. Pearson in the news this morning because they flogged the FT. Quite a remarkable story. Massive bidding war between a German media company who own, like Bild, one of the big German newspapers, and then the Nikkei media group in Japan. And the Germans have been trying to negotiate a deal for actually about 12 months. And the Japanese turned up just 5 weeks ago and stole the show. They nipped in there and put in a bid that was over and above the German bid right at the death. It went to the final 10 minutes before the deadline, and they snapped it up for, I think it was £893 million. So the Japanese outbidding the Germans right at the death, and so quite an interesting story. You can read about that in the FT. But yeah, Pearson in the news. It's their earnings today as well. Right, so let's get on with the session. Really, the main data coming this afternoon at 2:45 and 3 o'clock. But you know, a bit of a difficulty now on the earnings front. Amazon have just come in and steered and steadied the ship after what had been a very bad week for the big hitters on the earnings front. Amazon delivering monster numbers. Share price 19% higher. They're now bigger than Walmart, despite the fact their revenue's only 20%. All right, let's enjoy the day. Thanks.